Good morning, ladies and gentlemen. I'm Vidya, moderator for the conference call. Welcome to MAS Financial Q3 FY23 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participants will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal the operator by pressing star then zero on your touchtone telephone. Please note, this conference is recorded. I would now like to hand over the floor to Sankat from DAM Capital. Thank you, and over to you, sir.
Yeah, hi, good morning all. Today we are here to discuss MAS Financial's Q3 result. We have with us the entire management team, Mr. Kamlesh Gandhi, who is MD and Chairman, then Darshana Pandya, who is also Director and CEO, and Ankit Jain, who is the CFO. So without much ado, I would hand over the call to Mr. Kamlesh Gandhi for their opening remarks, post which we can follow up with question and answer. Over to you, sir.
Thank you, Sanket, and good morning to all of you. I'm happy to connect to all to apprise you about the Q3 working of the company. I think all of you must have gone through the press release and the investor presentation. But just to give you the performance at a glance, we had a very strong quarter once again, registering a 30% growth in AUM on a consolidated basis and a growth of 32% on standalone basis as far as the AUM is concerned. And as per our performance over more than 2.5 decades, this AUM is accompanied by a robust quality of assets and a good profitability. We had increased in the profit by 27%, and the quality of the assets remained benign at 1.60% stage 3 of our total AUM. On the fundamental side, we remained well capitalized at a capitalization level of 24%, with Tier 1 contributing almost 22% of the same. And on the liquidity side, we had ample liquidity on hand, and that translated into a liquidity of more than 1,000 crores on hand and an equivalent sanctions. And as I talked to you, we already tied up for the year and also for the Q1 next year, in lines with our working as far as the liability management is concerned. On the distribution front, we are now catering to potentially 7,900 centers through 149 branches, and along with our strong partnership with more than 150 of the NBFCs, whereby the contribution through our own centers has increased to 61% this quarter. In terms of while Ankit will take you through in detail on the liability discussion, but in terms of liability management and the interest rate, we could maintain well within the trajectory whereby we could maintain our NIMs of 7% plus, and at the same time could have sufficient liability on hand. On the employee side, we have more than 2,000 of a strong team and growing, and with the able support of the technology, we think we are here to increase our efficiencies on all count. We are happy to share that we'll be completing our first phase of our technology, our digitization drive, so to say, by March or latest by June, whereby all the processes will be digitized, and then we'll be taking it to the next stage of credit analysis through AI. But it will take its own time understanding the borrowers and then putting the system at a place in such a manner that technology is an enabler for a better credit. I'm happy to share the performance of our housing finance company also, where we registered a 30% growth in AUM and an equivalent growth in the profitability also. We have touched around 400 crores in AUM as far as our housing finance company is concerned, and we are very confident of growing this at the same rate given the current base. So that will also start contributing very meaningfully towards the total AUM of the MAS group. So all in all, a very strong quarter, the fifth quarter of growth in a row post-COVID, accompanied by very strong fundamentals. We have always maintained that all-round growth is development. We will not just chase the AUM irrespective of the asset quality and the profitability. So we have maintained and struck a balanced growth. That is what we call it as a real development. And going forward, we are confident of our robust compounding trajectory of anywhere between 20 to 25% of growth in AUM, and with a strong capital adequacy, mainly fueled through internal accruals. So with this strong fundamentals and with the economy also back on track and slated to grow anywhere at around 6% plus, we see strong opportunity for us to be growing at a consistent rate that we have been doing over last 2.5 decades. So it has been a performance which was quite satisfactory, but nevertheless we are not complacent. We are working on each and every aspect to improve the quality of the businesses we do and increase the stakeholders' value. Now I request Dashravan to take you through some of the numbers which are already with you, but just for the benefit of all of you, she'll take you through the key numbers, followed by Ankit with his commentary on the liability management for the quarter. Dashravan.
Thank you, sir. Good morning, everyone. I am happy to share Q3 and 9 months numbers for financial year 23. We have in our AUM, we have now 5 products to offer. Salaried personal loan is a new product, and as we can see, the growth is across all the products. So AUM as on December 22 stands at 7,606 crore, which is 32.46% growth from last year. Last year, the AUM was 5,742 crore. And if we look at the configuration of the same, the micro enterprise loan has increased by 31.39% from 2,875 crore to 3,777 crore. SME loan has also grown by 25% from 2,275 crore to 2,840 crore. Two-wheeler loan has grown by 38.22% from 363 crore to 501 crore. Commercial vehicle loans has grown by 26.76% from 230 crore to 292 crore. And since the salaried personal loan is a new segment, the comparative figures are not there. So the portfolio stands at 195 crore as on 31st December 22. And accordingly, in the same line, PBT has also increased by 27% on Q1Q and 9 months basis. And the PAT has also increased by 27.80% on Q1Q basis and 27.41% on 9 months basis. So profit as the PBT as on December for the quarter is 68 crore 53 lakhs as compared to 53 crore 88 lakhs last year, and the PAT stands at 51.25 crore as compared to 40.10 crore last year. For 9 months, PBT is 155 crore as 196 crore as compared to 155 crore last year, and 146 crore is the PAT as compared to 115 crore for 9 months last year. We also could maintain the quality of the portfolio as shared by sir. So our gross stage 3 as on December is now 2.23%, and net stage 3 is 1.60%, which was 2.26% gross stage 3, and net stage 3 was 1.60% as on 30th September 2022. This was about the parent company. Now coming to the housing finance company. Here also we could cross the mark of 400 crore AUM, so which is 31% growth in our AUM from 307 crore to 400 crore. PBT also grew by 30% from for 9 months from 4 crore 28 lakhs to 5 crore 55 lakhs, and the PAT has increased by 30% from 3 crore 34 lakhs to 4 crore 4 lakhs. For quarter, the PBT is 2 crore and it has grown by 50.76%. PAT is 1 crore 59 lakhs and it has grown by 52.75%. So all in all, we can see that we have gained a strong momentum, and going forward also we are confident to continue the same. Now I'll request Ankit to take you through the capital and liability management during the quarter.
Yes, thank you, ma'am. So good morning to all. To further elaborate on the liability management, we through our efficient liability management was able to maintain average liquidity buffer of around 700 crore during the quarter and unutilized cash facility of around 400 crore. In addition to this, we have sanction on hand to the tune of around 1400 crore in the form of term loan, direct assignment, co-lending. In the last quarter, we did around 355 crore of direct assignment transaction with various banks, and we have further more than 800 crore sanction on hand, which we will be utilizing during the coming quarters. In the last quarter, we did around 82 crore of co-lending transactions. The company has tied up with 3 banks, namely Bank of India, Bank of Maharashtra, and South India Bank. We aim to maintain around 20 to 25% of AUM as off-book through direct assignment and co-lending transactions. Company has available cash facility of around 1825 crore, out of which we maintain utilization of level of 65% to 70%, and this portion is kept as a liquidity buffer. In this quarter, we successfully rolled over around rupees 1450 crore short-term working capital loans, which are sub-limit to this cash credit limit. We raised around 670 crore term loan during the quarter. This helped us to further strengthen the asset liability maturity pattern, and we have more than 500 crore sanction on hand, which we will be utilizing during the coming quarters. Also, we have assessed the structural liquidity for the period ended 31st December 2022, and based on the assessment, there is no negative impact on liquidity, and the cash flow in all the cumulative buckets remain positive. As told, the capital adequacy remains strong at 24.47%, with Tier 1 capital of 21.21% and debt equity at 4.16 times. Also, to add on, we raised around 35 crore subordinate debt during the quarter, which qualifies as the Tier 2 capital, and thereby further strengthening the capital structure. The cost of borrowing for the quarter was at 9.15%, and for the 9 months from April till date was 8.92%. And given the increasing interest rate scenario, whereby RBI has already increased the repo rate by 2.25%, we see that in the medium term, the cost of borrowing will settle around 9.25 to 9.50%. Thank you.
I am just to add before the question answer begins, I am happy to share that the board is in this meeting yesterday decided to declare an interim dividend of 1 rupees 80 paisa per share. That is 18% dividend. So that was decided yesterday, and this is an interim dividend, and the final dividend will follow. Thank you. And we are now open for the question answers.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. We will wait for a moment while the question queue assembles. The first question comes from Sarvesh Gupta from Maximal Capital. Please go ahead.
Good morning, sir, and congratulations on a good set of numbers. So I just wanted to understand few things on the P&L. So one is your fees and commission income and been sort of moving in line earlier, but now it seems that there is some deviation in the quarter. The fees and commission income has gone down much more, and the expense seems to be where it is. So if you can throw some light on that. And secondly, again on the OpEx, both employee and other expenses have been rapidly sort of going up, slightly more than the AUM growth. So are there any one-offs related to the tech investments that you were sort of alluding to, which will be over by June quarter? Or if you can throw some light and understand, what's happening on that front.
Starting from your second question, in terms of the increase in employee cost, as you see that the share of the retail assets originated through our own distribution is increasing. And as I shared, it will be in line with the expenditure we incur in originating such businesses. Whereas when we originate through our NBFC partners, it is upfronted in the interest we charge. So, and as you see, we have rapidly expanded our distribution base also. So currently we are working at a potential 7,900 centers through our 149 branches. So the expansion of the branches and more share of retail assets origination through our own distribution is the underlying cause for the increase in the OpEx. In terms of fees and income, we need to see that into two parts. On the income side, this fees and commission is a function of the charges we get from time to time for setting up the limits for our NBFC partners. And as far as the expenditures for fees and commission is concerned, it is the function of the commission we give for origination to various origination partners. So, depending upon the business model and the opportunity we get, the fees and commission income will vary from time to time. And in terms of the expenditure, it will be in lines of the growth in the business on a quarter-to-quarter basis.
Understood, sir. But so what can be the normalized income level as a percentage of AUM? If you can, if there's some ballpark that we can sort of pencil in.
Difficult to give off the cuff because these are the incomes that we get from time to time on setting up the limits for our NBFC partners. So as a ballpark can be shared with you offline, but currently it's not much of the focus area as far as the income is concerned. This is just for better transparency and for a better understanding. It has been shown as a separate line item in our P&L. But even then, based on the projections from time to time on what are the limits we are going to give to the various NBFC partners, that will decide the fees and commission income from time to time.
Understood. And on two-wheeler loans, so now it has grown quite handsomely in this quarter, but earlier we were sort of very cautious on this side. So has the environment changed for you or the industry in general with respect to the two-wheeler loans, or if there is any other reason why it has grown so strongly?
So there is a base effect. If you see there is an increase in sales in two-wheelers both in the urban and in the urban areas in the hinterland post-COVID. So once the basic sales increases and which is now coming, which came back to the pre-COVID levels, and now we are seeing that will cross the pre-COVID levels also within a quarter or two. So that is a base effect because of the more primary sales, the financing opportunities are more.
Understood. Any sense on the excess liquidity that we are carrying now? I think earlier we were alluding that we would want to reduce it in the coming quarters, but it seems that we are still carrying the excess liquidity. If you can give the amount and the reason.
Strategically, we would like to carry liquidity of close to 4 to 5% of our AUM. That comes to close to around 400 crores, 4 to 500 crores. And which earlier was close to 1,000 crores has come down to 770 crores as shared by Ankit. And the unused cash credit limit is not it's not a burden as far as the treasury management is concerned. So that's just a liability management pattern. So what was around 770 crores within next few quarters, we'll see that settling anywhere around 4 to 500 crores.
Understood. Thank you and all the best.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have any question, please press star and one on your telephone keypad. I repeat, ladies and gentlemen, if you have any question, please press star and one on your telephone keypad. We have a question from Harshavardhan Agarwal from IDFC AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. I just wanted to understand on a disbursement outlook, because if we look at our last 3 quarters run rate, we are sort of flattish at somewhere between 2,100 to 2,200 crores. So how should one model this, and what would be your expectation for the FY24 disbursement?
See, our focus is to have a growth on AUM, and depending upon the product mix we have in our AUM, the disbursement growth will be the function of that. So it does not necessarily mean that the higher AUM will correspond equally to the higher disbursements. So our focus will be on growing the AUM anywhere between 20 to 25%, and the disbursements will be calibrated accordingly. So if you see on a Y2 year-on-year basis, last time from a 1,600 approximate 1,600 crores of disbursement, this year it's close to around 2,200 crores. But on a quarter-to-quarter basis, it will more or less stabilize, and then also we'll be in a position to have a growth of around 20 to 25%. That is because of the various tenures of the loan we extend.
Right, sure. Thanks, sir. So next is on the liquidity part. I'm sorry I could not get it earlier, but you said the current liquidity on the balance sheet is somewhere around 700 crores. Is that correct?
Yeah, 770 crores, sir, right?
700 crores.
Yeah.
But my understanding was in the last Concall you had mentioned somewhere around 600 crores is the liquidity that we carry, and if excess liquidity we have is of 770 crores this quarter. But if I were to look at the increase in borrowing, that seems to be much lower than the growth in our advances in AUM. So I'm just not able to understand this, because my thought was that probably we have used some liquidity during this quarter. That is why our borrowing growth is much lower than the advances growth.
So this is on a given date. When I'm talking about the liquidity we carry, it is on the average for the whole quarter we have done. So the liquidity on a particular date will not show the exact picture of the liquidity we hold, because few of the sanctions might have been availed on the last date for better relationships with the lenders. So that dynamics will be shared with you on what were the total borrowings and how was the excess liquidity used during the quarter which we had carried in the earlier quarter. But strategically, we would like to maintain a liquidity buffer of close to 4 to 5%. We are still holding some additional liquidity, which I think within next a quarter or two will settle around 4 to 5%.
Okay. So then the margin expansion on a sequential basis that we have seen, is it attributable to the product mix or the rate hikes we have taken?
It's a combination of both. Because as I've shared earlier also that we have enabling agreements with the borrowers to increase the rate as and when we need to. As such, that is our last priority, because we would like to be consistent on our offerings on rate. But as you know that this was a very unprecedented situation in terms of a very consecutive rate hike. So we had to use that option to increase the rates, and also it's the function of the product mix which changes on a quarter-to-quarter basis.
Sure. Thanks. So just one last question on our write-off. Did we have any write-off this quarter?
Yeah. That's the regular feature to maintain the policy.
Quantum, that would be helpful, sir.
Write-off was around 8 crore.
8 crore. Sure. Yeah. That is. Thanks. I'll join back with you. Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and one on your telephone keypad. We have a question from Pankaj from Molecule Ventures. Please go ahead.
Hi, sir. Congratulations on the good set of numbers. My question was on the yield side of our book. So what is our yield for this quarter as compared to pre-COVID levels of yield?
So I think when Darshan shares the number, the focus was on NIMs, and our NIM we could maintain at 7% plus. And if you can take them to the consolidated.
Sir, do you have? Yeah, go ahead. Sorry.
So yield on for all the products is around 16%, 16.5%.
Okay, and what was it for the pre-COVID, let's say FY20?
Right, 20. Can we share that offline? Because right now I'm not having those numbers with me.
That's fine. And do we have any further scope to increase our yield in FY24 or in next couple of quarters, let's say?
Your focus will be to maintain the NIMs. So the yield will be the function of the borrowing cost, the operational cost, and the credit cost for a particular product. So it will be in line with our concept of maintaining 7% NIMs. So the yield will vary accordingly. So difficult to exactly figure that, give the figures on the yield that going forward, but we will try to maintain the NIMs of around 7%.
Okay. That's it from my side. Thank you.
Thank you, sir. The next question comes from Ojashwi Kicha from TCG Advisory. Please go ahead.
Yeah, hi, this is Ojashwi Kicha from PGIM India. So first question is on OPEX. While you have commented primarily, higher OPEX is led by, I think branches and, partnerships with fintech. So if you can give broad color, in terms of where do you see this operating expense ratio settling? And also, if there is any way to, break this, how much is basically due to, expansion of branches or, partnerships, that would really help.
Right. So on the OPEX basis, on a consolidated basis with more contribution from our direct distribution, we see this settling anywhere between 2.5 to 3%. Factoring in the fact that we'll be continuously growing our distribution strength also, and which will have a lag effect on the efficiencies. So we anticipate that in the range which I shared.
Sure. Any broad breakup like this incremental, higher expenses into categories? If you can allocate.
Any breakup on?
I mean the higher incremental expenses into categories. So you have broadly mentioned qualitatively branches, employees and partnership. So what percentage would be due to branches or due to partnership with fintechs? Any broad numbers?
It will be mainly contributed to employee costs because in our business there is hardly any cost as far as the branches and the expansion of the branches is concerned. So it will be mainly on the origination and the OPEX and the employee cost, and it will be the origination that we pay to our fintech partners and all. So it will be mostly on the origination cost part of it.
Sure. And where do you see branches numbers by FY24 or FY25?
I think we contemplate that within next 2 years we'll be close to 200 branches and 10,000 potentially 10,000 centers of penetration. Maybe a few quarters here or there depending upon the opportunities that we discover from time to time working at those places.
Sure. The second line of questioning is around the yields. So broadly, you have given 16.5% yield across products, more or less. So I mean, during the quarter, which products did you see the highest increase, and where do you see the further flexibility?
Darshan will share the product-wise yields, but I would like to maintain that on a consolidated basis, the company over the years have endeavored and found that maintaining 7% NIMs and ROA is anywhere between 2.75 to 3.25%, works as a good enablers for creating good quality assets also. So strategically, it will revolve around that, while you can take them on the product-wise yield.
Yeah. So our MEL yield is 17% around, SME is 15%, two-wheeler is 15.5%, SRTO is 17%, and SPL is around 19%.
Sure. And if you can also give the last quarter number for these products, please.
Last quarter, it was MEL was also, again 17%, SME was 14.75, two-wheeler was 16.5, SRTO was 16.75, and SPL was around 18.5.
So last question from my side is if you can provide some commentary around the competition, any changes, any pockets that you in the spaces where you operate, any change in the competitive intensity over last 1 or 2 quarters that you see?
We see continuously the continuous entry and exit of various financiers, be it NBFCs or banks with the various products we work. But having said that, and that what we have maintained over all this 2.5 decades of working, and that given the market size and the market differentiation and the product differentiation in the marketplace, we always found ample opportunity to grow the products the way we want to grow. And that is what we have demonstrated over all these years. So it's a continuous process whereby there are a number of players entering with certain products and certain people exiting. And especially there has been a lot of interest in the SME side of the business, whereby even the private banks are also saying this is a good opportunity to contribute to the liability side of small entrepreneurs.
Understood. Thank you. All the best.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I request the participant to restrict with 2 questions in the initial round and join back the queue for more questions. We have a question from Dwanil Desai from Turtle Capital. Please go ahead.
Hi, sir. Good morning. Congratulations for a very good set of numbers. So my first question is on the OPEX side. I think you alluded that eventually that number will settle down around 2.5 to 3%. So currently we are at around 2.75% in terms of ROA, and we have given a guidance. So if this ratio, which used to be around 2%, moves to 2.5 to 3, does it mean that we will be closer to lower end of our guidance on the ROA side?
No, as I told that while OPEX yields will vary and will differ from quarter to quarter depending upon the product mix, our ultimate aim will be to maintain a 7% NIM and ROA is anywhere between 2.75 to 3.25%. When we talk about higher OPEX, it will be corresponded by higher yields also, with more contribution from the retail assets originated through a direct distribution. So that will not affect the ROAs. On the contrary, we are optimistic on improving our ROAs on a scale.
Okay, got it, sir. Thank you. The second question is on the new segment that we have started. So if you can share your thought process as to how we decided to enter into this salary personal loans. How do you see yields, margins, and the profitability?
See, as you see that we have been present in the income generating activities of the economy, be it our MEL financing or small and medium enterprise financing, or maybe two-wheeler, which is mostly used for not only commuting but for the business purpose also, and obviously commercial vehicle being a livelihood financing. So we were absolutely missing from the consumption side of the economy. and you'll agree that there's also a huge opportunity when it comes to consumption side of the economy. And in the past, we had managed this portfolio, but because of our more focus on MSME and given the constraints of the balance sheet size, we were not much focusing on the salaried personal loans. So this was the basic intent, that we would like to be on the consumption side also, but very cautiously. The way we'll grow this portfolio in a very cautious manner, and we see that with good credit underwriting, there are good scope to grow this product also.
Okay. Just to follow up on this, sir, but so on MSME side, we are in areas where some of the larger banks or NBFCs may not want to enter, but on the salaried personal loan, there are larger players. So, I mean, do we see enough space for us to be there and grow?
Yeah. There's a very huge market to be served. As I always share, that the overview can be that there's a lot of competition. But once you really start working in a particular place, you'll see a lot of product differentiation. And with good origination, understanding, good origination strategy, and last but not the least, the patience to wait for the portfolio to build up, you can definitely build up a quality portfolio there. It's a huge market to be served and growing.
Okay, sure. I have more questions. I'll come back.
Thank you, sir. The next question comes from Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, thank you for taking my question. A little bit of a continuation to the past, participants. So now we reach almost 200 crore in the personal loans. How are we looking at this product from a 5-year perspective? What percentage would you like to get in, this to? And also, given that we are focused more on, lending to the MSMEs, I mean, would you consider extending these loans to the self-employed also?
See, over the years, we have always believed, and that too at the initial stage of the product, that the growth opportunities will not be decided, will be discovered as we go along, depending upon the risk-adjusted returns we get from time to time. So there are no hard-hammered targets being set for this product as of now. But having said that, with inconsistency with our overall strategic planning to have a well-diversified portfolio, I don't see, even though this giving a good risk-adjusted return, this product to contribute more than 10% going forward.
Okay. And what about extending this towards the self-employed? So right now we're doing salaried personal loans, right? But I mean, a lot of our loans go towards micro enterprise loans and SME loans, which are, really kind of almost can be categorized under the self-employed category. So would you give them also personal loans, or that is a separate thing that you wouldn't consider?
No, this personal loans are basically, when we give consumption loans, the idea from the credit and the risk perspective is that we want a fixed income parameters to be judged. So right now we are concentrating on personal loans only to the fixed income earners, and not contemplating giving personal loan as of now to the self-employed.
Okay. All right. Thanks a lot.
Thank you.
Thank you, sir. The next question comes from Saptarshi Chatterjee from Centrum PMS. Please go ahead.
Good morning, sir. Thank you for the opportunity. I just want to understand your off-book percentage. So pre-COVID, it used to be slightly higher at around 40%. Now we have come down to closer to 20, and we want to maintain closer to 20 to 25%. May I know what has led this change?
See, if you see pre-COVID, 40% on a smaller balance sheet size, a lopsided or a rather more concentrated liability from a source was acceptable. But as we grow, strategically we have decided that no liability source should be more than a certain percentage of the overall liability configuration. So with these lines, as Ankit shared with you, that we like to keep this anywhere between 20 to 25%. So this was the effort in that direction, accompanied by, as I shared in few of the last conversations, that excess liquidity with us was also one of the function that we could not do a lot of direct assignments with the banks, because when we do direct assignments, that amount comes in bulk, where it cannot be tranched the way we would like to have it in tranches because of the excess liquidity we carry. So this is the function of both the things. Our strategic intent of not to rely on one liability source for more than a certain percentage and carrying excess liquidity.
Understood. And if I just compare your 1 to 30 DPD quarter on quarter, there has been slight around 25-30 basis points increase in 30 DPD. Is there anything to read about it?
No, that is within the routine course of business. That much fluctuation will happen. So that is nothing much to interpret there.
Understood. And lastly, can you please give your state-wise AUM breakup, if possible?
That we'll share it offline, because we work with we work directly in 6 states, and through our NBFC partners we have a multi-state penetration. So I request Ankit to share it offline with you.
Sure. Thank you so much, and all the best.
Thank you, sir. The last question comes from Avadut Joshi from Newberry Capital. Please go ahead.
Hi, good morning. Thanks for the opportunity and congratulations for the good set of numbers. Just one question. In the initial remarks, you mentioned about digitalizing or the use of AI for the analyzing or adjusting our lending process. In that sense, I just want to know how we are going to use it going further and how it will help us in scaling, both in the sense of whether we would plan to use it in geographical and the product-wise scaling. What are our plans over there? Thank you.
So on the digitization front, right now we are in the process of digitizing the complete processes end-to-end, whereby the turnaround time is reduced. And in the second phase, we would like to introduce AI selectively, as I shared in the beginning, that we like to understand the use of AI and how it really works and complements our credit decisioning. And that too, depending upon the product where we have sufficient documentation available to do the analysis based on the basic data we receive. So AI use will depend on from product to product, from time to time. Gradually, AI will be introduced as an enabler for credit decisioning, and will not be the only criteria to extend credit, because the borrowers whom we serve largely depends to the informal category where we need to derive the credit assessment through various. Said that use of technology is inevitable, and we are moving on those lines, whereby we'll be completing the process part of it by say March or June for the complete product, and then switch on to getting help through AI for credit decisioning. It will be an enabler and will not be solely depending on it.
Understood. And do we plan to use it for any product or of course, increasing the products like we have now entered into personal loans? Accordingly, any plans to go into new geographies plus new products?
Product won't be new, but there will be new set of customers within the product which will be in a position to serve better. Say for example, in our SME product, where through with the help of account aggregators, when we can have a direct access through their banking, GST, and the credit bureau data. Such type of borrowers where with the help of AI can be analyzed fast and helps us in credit decisioning. So we can add on to those type of borrowers which ideally would like a better TAT than what we are having right now. The same is the case with personal loan, whereby there's banking analysis and then analyzing their repaying patterns and calculating the disposable income might be helpful in our credit decisioning. So within the product, we envisage that we'll be in a position to entertain new set of borrowers who are tax sensitive and are at the upper end of the credit assessment.
Understood. Thank you. That's it from us.
Thank you, sir. The last question for the day comes from Ritesh Parekh from Motilal Oswal. Please go ahead.
Thanks for the opportunity. Just a couple of questions. One is I want to understand what is the loan origination from the fintech side on the overall for us?
600 crore for the quarter.
And how is our experience in terms of quality means in terms of the repayment and asset quality side on this?
It has been on the lines of our normal product because when we originate business through fintechs, it is as per our credit screens, whereby the credit screens are given by us and we filter the cases originated by them basis our credit screens. So our experience so far has been encouraging while originating through this fintechs, and it is in lines with our direct origination.
And lastly, on the CV side, I see that we were looking at aspiration to grow it on the big side, but somewhere it is around 3.5% 4% range as such. So any thought on that?
I think as we know that CV is directly related to the consistent growth in the economy. If you are looking at a risk-adjusted return in this segment, and if you see continuously over quarters, we are growing that portfolio because on a quarter-to-quarter basis, we could register a growth of around 27%, maybe on a lower base. But that is how we work, that we will be growing steadily in this segment, and God willing, if everything is fine with the economy and grows consistently the way it is growing right now, we should start contributing more than what they are contributing to the overall AUM.
Thanks. That's it from me.
Thank you.
Thank you, sir. Now I hand over the floor to the management team for closing comments. Thank you, and over to you.
Thank you. Thank you all of you for participating in this conference call despite a very busy day today with a lot of results. And as shared earlier, we remain committed to our mission of excellence through endeavors and adding value through our work to all the stakeholders. And going forward, once again, I like to reiterate that we are confident of a very consistent growth that we have demonstrated over all these years, and not only growth but development accompanied by good profitability and asset quality at the rate of 20-25%, which doubles our AUM and profitability anytime within 3 to 4 years. I think that strong compounding working and that strong compounding story as far as math is concerned will continue. Thank you so much for the participation, and all the best to all of you. Thank you.
Thank you.
Yeah, thank you.
Thank you. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Doorsaba's conference call service. You may disconnect your lines now. Thank you, and have a pleasant evening, everyone.